Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
However, when we went and did the review again for the full year, I did not have the 3 consecutive days in August. And it didn't dawn on me before, obviously it dawned on me now, that the reason why is because after September, there were actually subsequently higher values than what we were seeing earlier in the year. So the values didn't qualify any longer as 10% highest values. And so you'll see here the 3 highest values, or what qualified as 3 highest values, were certainly any number of 134 and higher. And yet by the end of the year, 134 did not qualify as 10% highest values. So this is, I guess the point they're trying to make here is it depends on the time frame that you're using for your analysis. When we used 8 months of data and 10% highest and lowest values, we saw these consecutive high numbers. However, when we used a full year's worth of data, these numbers, the consecutive highs, did not show up any longer. Now, again, if you're looking at it on a daily basis and you track it on a daily basis, then you would have seen the 3 highs in August, and hopefully if you did and you acted upon it, you would have made a great decision by getting out of the market at that point. Right? Again, if you're looking at it at year end, you'd say, well, I don't even see it. Didn't appear to give that indication that the market peaked. But again, on a daily basis, it did. So what I'm going to do then is look at something a little bit different. Look at what I'm going to call the threshold for analysis. So again, we just pulled 10%. We used the 10% number for no other reason than we were trying to narrow down the values that might represent extreme high values and extreme low values. So we used 10%. However, if you said, well, I want to use 15% or 20% only, or I thought 15% was a little bit high, so I actually split it down the middle and just said, what would have happened if I used 12.5% of the highest values and 12% of the lowest values? And if I used 12.5% as a threshold, even at year end, these consecutive highs in late August would have shown up. So the point we want to make here is that our methodology is very simple, and we're not saying it's the right methodology, the best methodology. It's just one methodology, and if you're actively looking at this data and following it, you certainly may want to consider what makes more sense. And the reality of it is, if you looked at the data over a longer time period and played with the data a little bit, you might find with a large statistical sample, the exact threshold that makes the most sense, where the ISEE is very representative of determining turns in the market. And again, it's just, we look at this as a single indicator. I certainly wouldn't recommend anyone making a purchase or sale decision based solely on this index value, but we've seen, and as a number of other people have seen, they have written articles and stories about the ISE index on our website, that it generally tends to be a pretty good indicator of turns in the market. Okay. Now, the other method of analysis that I wanted to look at, we've always looked at all securities, right? But if you follow any put call data at all, by the professionals in the marketplace that write newsletters and that write about put call data, they generally always include all equities only data versus the full put call data. So in July of 2007, we started producing an all equities only value as well on our website. And so again, and this was driven by people like you asking about, hey, what would be the difference with looking at other securities than just all securities. And so we broke it up and we showed all securities. We showed equities only, and then we also show a value for indices and ETFs. Okay. So if we now go one step further, what I'm going to show you is this subset of the spreadsheet actually is showing, you'll see the date in the middle column is all security values, and then to the far right is the equities only values. And what is interesting here is, if you remember after the big correction we had from September onwards last year, that there was a pretty significant rally late in the year, late November actually. And if you were looking at our all securities only values, you didn't get what we call the clustering, or the consecutive days in a row of low values here with all securities. However, if you were also tracking the equities only values, you would have seen we had 3 consecutive lows in a row here in late November that led to a pretty significant rally in the upside in the market, certainly in November and December. And then again, if you're following this and using it as an indicator of turns in the market, it was interesting to see here that at the end of December, the all securities values had 4 consecutive highs in a row, and the all equities, or I'm sorry, equities only had 3 consecutive in a row. But you'll see this 170 in between here wasn't too far off of 173. So you certainly had 3 in a row, almost 5 in a row. So again, the challenge here with looking at the data is as we indicated in the paper, that these values came late in the year, during a holiday week where volume is lighter, and the question becomes, is this volume truly representative of the marketplace? And again, that's something you need to factor in to your decision if you'd want to use it at that point. However, we have data available going all the way back to 2002, and you could look at this time frame, late December, going back over the years, to see how representative it was over the time period. To see if, even though the volume's lighter, did it truly indicate that there were turns in the market? So, in this case, had you followed the all equities data, you would have certainly been intrigued by the 3 consecutive lows in November. You had certainly a subsequent rally in the market from there. And if you followed it and got out at the end of December, it probably would have been a pretty good move again, because after the new year, the market went sideways. It went down a bit. And what's also interesting with the all securities values, we had 3 consecutive low values again with the all equities values in March of this year, which again was, the timing worked extremely well, and the market certainly has had a significant rally since the lows in early March.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.